Ready? Welcome back to the Mortgage Chatter. I'm one of your hosts, Tyler Kornhauser.
And I'm Ken Land. Thank you for joining us.
Yep. Taking a step back towards mortgages this time after we spoke on Fairway as a whole. So
We're back.
we're back. What happens after you close with Fairway though? That's the big question now.
Yeah, and we get a lot of questions on that topic. I mean, we've talked about the process and getting to that, but yeah, you go to the attorney's office, you signed. What
Now
next?
what? Now
Right?
what? Yep.
What happens?
Oh well.
Let's put you on the spot. What do you got?
Well, typically we hold on to the loan for 30 to 45 days. You make your first payment through us for the most part. Correct me if I'm wrong. And then
So far, so good.
we sell it off to a servicer.
Mhm.
There's a few servicers we work with, and they pretty much take over with the mortgage at that point, in terms of collecting payments, paying the escrows, handling all the behind the scenes fun stuff. So
Right. And service the loan, right?
yeah, exactly.
Now you're spot on. I mean, you sign the papers, and everything closes in Fairway's name because we're a lender. It's funded in our name. We're providing our own money. We've got warehouse lines that fund it. And you're right. I mean, it's kind of one of those scenarios where over time the loan will be sold.
Mm-hmm.
It'll be transferred, and by and large, that's where Fairway's going to make its money. And we're not a large servicer. I mean, we're not in the collection piece of it. We're not collecting the monthly payments. So the loan could be transferred out. And there's numerous different servicers out there. Don't need to get into all the different names or whatnot, but I mean there are out there. The cool thing is, and I think this is one of the biggest questions, is the loan could be sold 200 times, but the terms and conditions of the loan will not change.
Mm-hmm.
I mean that note is the same with whoever goes. The only thing that changes is who's taking the money out of your account, essentially, or who you're writing the check to, right?
Yeah.
So, I mean, I think that's probably one of the biggest concerns people have is, when you close the loan and then, say 15 days, 30 days later, you get this welcome aboard letter from another lender. And it's
Yeah.
like, whoa, who are you? What's going on? But the terms don't change. So,
Yeah.
I mean, it's just, that's pretty much how that works.
So why would a servicer want to purchase a loan from us, for example?
Right. I mean, at the end of the day, a servicer is buying, trying to keep me from getting technical, but I mean, the simplest way to look at it is, a servicer, they're in the business of collecting payments.
Mm-hmm.
So a mortgage, what is it? It's a monthly payment. There's interest and principal, right?
Right.
Well, that interest is an annuity for the servicer. So that's where they're basically making money. They're
Got
going
it.
to collect, they're collecting the payments, whether it's on behalf of Fairway or if they actually own the actual mortgage itself, then they're collecting it and they're keeping that, and that's how they're generating their money. So
Okay.
it's just another channel of business and how people are out there making money. Right?
Fair enough. Yeah.
And we originate the loans, and we'll sell them, or we do retain some servicing, but by and large, we do sell the bulk of our loans off. And there's companies out there that want to buy loans,
Yeah.
right? They want that stream of income coming in and roll from there. But that's when we're talking servicing, it's who's on the mortgage statement, who do you call to get help,
Help with
who's
what?
assisting? Help. Say you're in trouble.
Yeah.
In the Western North Carolina, Southeast, we've had multiple storms come through.
Mm-hmm.
And, unfortunately, there's people that can't make their mortgage payments, so you can call and make payment arrangements, or maybe you need some documents from the closing or whatnot. They retain all that information, so they kind of become the keeper of all pertaining to your loan, and you kind of walk through that with them.
Okay.
So
I do know that servicers do other things on top of that,
Mm-hmm.
mainly along with escrow. That's a big
Very
thing.
true.
So,
Very true.
I mean, we've talked about it. You have escrows included in your mortgage payments for things like property taxes and homeowners insurance. And the servicers are the ones responsible for making sure your property taxes and homeowners insurance are paid each year.
exactly.
And that's part of the reason why you pay them into escrow, for
Mm-hmm.
them to be able to take that money and pay those fees for each prospective allocation area.
Yeah, the bills, right?
Yeah.
I mean, they become your budget, basically, or the budgeter. They manage the money for you as you pay into that savings account, so that you don't get stuck with a big bill at the end of the year for the taxes, and whenever the insurance renews, the bills are supposed to come to the servicer. So that's another time you're going to interact. So if
Yeah.
you change your insurance company or whatever, if you receive a county tax bill and you have an escrow account, well, you're going to send that bill to the servicer,
Mm-hmm.
right?
Yeah, for sure. And servicing, I feel like it might scare some people, selling the loan to another servicer.
Yeah.
Is there sort of like a comforting thing that the servicers do to make sure they know that everything's taken care of, or is it?
Yeah, I mean, the big thing with it, and what we have to continue to do on our side, and please take this message again, the terms of the loan do not change. That's probably the biggest question I've ever been asked, and the most frequent one is, oh my gosh, is my loan gonna change? Is my payment gonna change? Because, people budget, the payment is what it is, and they don't wanna see that payment change.
Mm-hmm.
But again, you will always receive, there's a bunch of, fair lending laws and RESPA laws around the timelines and the notifications that have to go out. So when the loan is being transferred, you receive not only a letter from Fairway letting you know that your loan is being transferred, you receive a welcome aboard letter, and then more information is going to come.
Mm-hmm.
Generally, servicers also call. Not many of us answer telemarketing calls because that's kind of what you think they're going to be, but a lot of them do call to let you know. If your emails on, kind of we've gotten to the day and age of online as well. I know several that send out emails, that let people know as well. So, there's a lot of different ways that that a client is contacted to let know, and then we on our side we know. So if you've done a loan with Fairway, hopefully your loan officers let you know as well that, hey, your loan's been sold to XYZ servicer, to be on the lookout for. Because if you're like me, junk mail goes in the junk. Right?
Yeah.
I mean, if it's not something I was expecting, I don't even bother opening it up. So that extra phone call, right? Well, that extra phone call does help. So, but now a cool thing is, and this is another regulation that's out there that it's a good one, is you have a grace period. So if a loan is being transferred, so say you made the first payment at Fairway, right? And the loan is being transferred, being sold or whatnot, but you're making your second payment, you send it to Fairway. Now, servicer Bob over here is looking for the payment, but it's already been paid to Fairway. Well, Fairway is going to forward that payment to servicer Bob here, and even if it's late in getting there, or if you're late paying because you're confused on who's paying, there's a grace period that's extended to where you can even be 30 days late, and you're not going to necessarily, and I'm not saying miss payments or anything like that, or don't make your mortgage payment, but what I am saying is to take down the stress, there is this grace period that's built in there to say, hey, listen, your credit will not be infringed upon or whatever, knowing that there's some shuffling around, so to speak, that's going to happen. I think that's probably another anxiety that I've seen with clients in the past is, they get the transfer letter, but they'd already sent the payment in. Because sometimes it happens even before that first payment is made. I mean, sometimes it's very quick. Yeah. And if they've already made that payment, it's not a big deal. I mean, Fairway's going to get it. They're going to forward it because Fairway knows where the servicer's going, so they'll forward it to. And then years down the road, say you're with Bob servicer and it's transferred to Sally servicer, right? If you've made that payment to Bob, but it's now supposed to go here, they will do the same. The payments get forwarded, and that same grace period is afforded during those times as well.
Gotcha.
So
now I did want to ask, because you mentioned, say we sold the loan to servicer Bob, right?
Sure.
And then you said that your mortgage could be sold to a bunch of different servicers over the life of the loan. What would inspire the other servicers to turn around and sell the loan after they've purchased it? Is it like a time frame thing? Is it switching the market, or?
Yeah, it could be a bunch of things. I mean, it kind of goes back to Econ 101, the value of future money versus present money, or present money versus future money. So, again, going back to a servicer, they're collecting interest payments. So the longer they hold the loan, the more money they're going to make off of, or more revenue that's going to come in on it. So, servicer Bob here may say, well, all right, well, we'll sell this loan for X amount of money to another servicer. They'd rather just go ahead and take that check now. And part of it comes down to, and I know we're going to go to this in a bit, is the propensity of a loan to be paid off, right? Because again, if you're expecting a stream of income coming in, one of your biggest fears is that loan being paid off, right?
Yeah, for sure.
So as market conditions are going to fluctuate, the risk of that loan being paid off could be good, it could be higher, it could be lower.
Okay.
So for instance, if rates at a 6%, where the market's at now, you're starting to get to, but you're not there yet, where that loan could be refinanced for a lower interest rate. So loans that are like, say, 15% right now, those are going to get paid off.
Yeah.
Because rates are, in theory, lower. But people that did loans back in, say, the 2020s and 2021s, where rates were historically low in the 2 or 3% range, those loans aren't going to necessarily pay off real quick.
Yeah.
Right? So that's going to drive a lot of it, but it comes down to simple economics of do you want to continue the stream of income, or do you want to take a lump sum? Because if you're coming in and buying a mortgage, obviously you've got to pay for it. Right?
Yeah.
So.
And when you say pay off, do you mean like the borrower pays the whole thing off, or in terms of a refinance, or?
Yeah, a borrower paying it off, and you look at the historical averages of how long people stay in homes as well.
Okay.
Right?
Mm-hmm.
I mean, people tend to move from house to house. Now that number does change. I mean,
Mm-hmm.
the first number that kind of comes to mind, I know that one of the historical averages from years ago was, people typically move about every, 5 to 7 years.
That sounds good.
Right? So if you start getting into that threshold, that mortgage is getting that old, then you're starting to run against the averages, right?
Mm-hmm.
So, servicer Bob might be like, this loan might be paid off soon. It might be good to pass that on to somebody
Gotcha.
else.
Okay,
right?
that makes sense. Yeah.
And it also goes to the type of loan. I mean, speaking from personal experience, our first mortgage is an adjustable rate mortgage that we did years ago. And there for the longest while, it sat with the same servicer because nobody wanted to buy that loan, right?
Yeah.
I mean, it's a great loan. We love it. But, and since it finally got sold, with rates having gone up or whatever, I've bounced through a few hands here lately, which,
Gotcha.
again, I've had this loan since, I don't remember when we took it out, like 2006 or 8 or something along those lines. And
Mm-hmm.
it stayed with the same servicer for probably 10-ish years. Maybe.
Wow.
Something along those lines, and maybe even longer than that. But recently it's moved around, so I guess they're thinking something.
Somewhere along the way you're gonna pay it off.
Exactly.
Gotcha. So with the payoffs, how does that impact the servicer? Well, they lose their loan, obviously, right?
There's a loan.
So that's not good for them because now they don't make any money.
Right.
So when you do go to refinance or move and that mortgage is looking to be paid off, the servicers will come at you hard when they find out that you're looking to pay off that mortgage or refinance or something along those lines.
Yeah, one of the, we'll call it the bane of existence right now. I mean, it's such a negative, and I mean, I wish there's legislation out there to hopefully it'll get passed soon that will ban this or greatly limit it. They're called trigger leads.
Mm-hmm.
So if Tom, we'll change it from Bob, we don't want to pick on Bob too much. If Tom has a loan out there, or he talks to you or talks to anybody else and has his credit pulled,
Mm-hmm.
the credit reporting companies sell the fact that Tom's had the credit pulled.
Yeah.
And for
Totally
good, bad, and
legal.
different, and want to make certain that everybody understands it is not the person you're applying with. And I'm assuming most cases, definitely with us, we're not selling anybody's information. The credit bureaus do sell, and again, they call them trigger leads.
Mm-hmm.
You've had your credit pulled and they're selling it to the servicer. They're selling it to, different mortgage companies that are going to come after you very aggressively because they know you've had your mortgage or had your credit pulled for a mortgage for some reason.
Mm-hmm.
Are you buying? Are you refinancing? What are we
What are
doing?
you doing?
So I kind of call it the ambulance chasers. I mean, for good, bad, or indifferent. I mean, they kind of come out of the woodworks. And I mean, you've experienced it with some of your clients. I mean, people getting called 20, 30, 50 times.
Yeah,
in
I mean,
a very short bit of time.
that's why I always start with a soft pull of credit until you're ready. I think because they don't have access to sell that information with the soft pull, and it also doesn't impact your credit scores. So
Yeah, that's a good point. Let's pause on that for just a second for those listening. I mean, it's if you start a pre-approval at a point, you are going to have a hard pull done. I mean, it's what you need to do.
yeah,
But always ask if a credit inquiry is going to be a hard pull or soft pull because there is a distinct difference in the responses.
yes, most definitely.
And I mean, it does not take long for those phone calls to happen. It's much like, it's liken it to if you get a speeding ticket or you've had an accident and all the attorneys that reach out immediately. And shortly after that, you suddenly have a ton of new love letters in the mailbox.
Yep.
They don't call, thank goodness, not yet at least. But in our case, again, for good, bad, or indifferent, the mortgage or the credit companies are selling all contact info, phone numbers included, and it's not information that can be being provided by us.
Yeah.
It's the information, because we could delete all contact information out of the system, pull the credit, and they're still gonna get blown up.
Because they still have access to
They
all
still
that
have
stuff.
information, which is a frustrating thing.
Yeah, most definitely.
Because nobody wants to get called 30 times.
No, but that's why I always suggest start with the soft pull, and it's not always 100% accurate. It could go either way, but it's pretty good ballpark.
That's a good.
It'll get the ball rolling pretty accurately. So
Absolutely.
But when it is time to get to that hard pull of credit, there's a few ways we can, what's the word, preemptively get around those.
Well, keep you from being harassed, because
Yeah.
I do want to say, we're not discouraging competition, definitely encourage you to shop around.
Yeah.
But harassment's a different thing.
Yeah, exactly.
Shopping around, calling a couple places, that's different than, even my son, when he bought his house in, last December,
Mm-hmm.
I remember he turned his phone off. He was getting
Yeah.
called so much, but yeah, keep going, sorry.
No, you're good. That's a perfect example. We try to send out what's called the do not call list instructions.
Yes.
I believe there's two different lists to
Sure.
get on. There's a do not call list, and then, do you know the name of the other one? Okay,
We'll get that information.
yeah, we'll throw it in the description, and we'll also
Yeah,
put
it's-
instructions on how to get on
Do not
that list.
solicit or something along those lines, but we'll put both information in there, and it's important to be on those even
Even if you're not.
if you're not in the market, because
Mhm.
one, it kind of limits the calls you're gonna get, and kind of keeps the scams away.
Yeah,
And
exactly.
protects people from
Yeah.
stuff, because there's a lot of scams out there as well. So if you're on that do not call list, unless you have a relationship, a consumer customer relationship, technically they can't reach out to you. Now, there's a lot of little loopholes and caveats. There are different people get in there and just sit in the kind of digged into every one of them, but it will severely or significantly reduce the amount of not just junk mail you get in the mailbox,
Mhm.
but also the glorious little phone calls that you get.
Yeah. So that's definitely, I just signed up for it the other day myself.
Yeah, put your cell, put your house numbers, put your email addresses, put your home address. And
Whatever
it is
they ask
amazing.
for, yeah.
Yeah, it is amazing, because it does cut down a lot of the pre-screens and a lot of the other, like I said, just the junk that
Mhm.
can lead to identity theft as well.
Yeah.
People get a hold of that stuff in the mail, it can run rampant on you.
Most definitely. But yeah, so that's a good glimpse of servicing. Did you want to touch on recast, or should we save that for another episode?
Well, it's something that a servicer can provide, so we can chat about that. So recasting, it is another function of the servicer,
Yep.
right? Recasting is where I'd say, and I've actually got a client right now that we're working with, buying a house, purchase price is like we'll just make up numbers, I think it's like $9,950, and they've got about 15% that they can put down. They've got that in their cash that they're willing to part with, but they are selling their house up north.
Yeah.
So when they sell that house, they're gonna have several $100,000 extra that ultimately what they wanna do is they wanna put towards the mortgage, to pay down the mortgage.
Yeah.
So rather than having to do a full refinance again, and again, you have to talk to the servicers, they've got different guidelines for
Yeah.
it. But a recast enables you to, say in this case, they're putting $250,000 down, taking an $800,000 mortgage down to, $550, $600, whatever they end up landing on.
Yeah.
And then they'll recast that balance over the remaining term. So say they're a year into it, so now they've got 29 years versus 30 years. So they'll take that remaining balance, re-amortize it, same interest rate,
Yep.
over the 29, so now the payment drops. Now they're gonna have some fees, nothing's free, right?
Yeah.
Everybody's always got fees. But it is definitely less expensive than doing a full-on, refinance. Now you can't do cash out, you're not gonna be able to do anything like that, just don't put down as much, but this does enable you to, again, it's a function of the servicer, to restructure that loan and lower the payment.
And I've got a very similar situation who originally they were looking to do some sort of bridge loan or a HELOC to take the money out of their current home to use as a down payment instead of doing a recast, but that's a bunch more hoops you gotta jump through, and of course there'll still be the same fees and all the paperwork, so a recast is a good option for putting a big lump sum down after you've closed, but still getting that lower loan amount in there with the same original rate, so.
Yeah, exactly. I was just thinking, squirrels are running, right? Another thing that you get, and everybody's familiar with this that has a mortgage out there, yearly, you get your tax statement, the 1098 form that shows how much interest you paid. So, that information comes from your servicer. So again, they're the keeper of a lot of information. Your servicer's your friend, some are better online versus, phone or, vice versa or whatnot. But, reaching out to them for the information is never a bad thing.
No,
So,
okay. That's good to know.
they're your friend. Best thing to do is always make your payments, so, I've always said, at the end of the day, the servicer does not necessarily really matter, so long as you're making your payments on time.
Makes
After
sense.
that, you start making your payments,
And they not
all
gonna be
servicers
happy.
become, they start calling, so, they are responsible for ensuring that you're making timely payments, and they're the ones reporting it back on the credit report,
Mhm.
right? They're the ones that would ultimately start a foreclosure process if you
Yikes.
stop making the payments, so, they get the bad rap. If you ever Google
Better
any.
than us.
Well, there's that, but if you Google any mortgage servicer platform, the reviews are typically pretty ugly,
Mhm.
which would scare you, but it's also.
They don't have a choice.
The line of work that they're in, unfortunately, they're the ones that are, sometimes the bad guys,
Mhm.
where, nobody's happy with the foreclosure, right? But, the circumstances are what the circumstances are.
Yeah.
And you work through it, so, there you go.
All right. Well, I think that was a good little gist of what servicing is and a few of the different aspects of it. But
Yeah.
as always, if there's any questions, something that we didn't miss, or something specific that you guys wanted to hear about servicing, feel free to leave a comment, shoot us a message.
Exactly.
Be happy to address it in our next episode. But
Exactly, and again, servicers, it's a part of the mortgage world, it's part of the
Mhm.
mortgage process, and anytime you close a loan, you just gotta keep your eyes out for the information. Your lender should keep you in the loop on it, and, take it from there.
yes, sir.
All right, well, thank you very much for your time and tuning in this episode.
Happy Thanksgiving and cheers.
Happy Thanksgiving. Cheers.